Good morning, everybody, or good afternoon, or good evening if you're in Australia. My name's David Russell. I'm chair of the Transition Pathway Initiative, and you're logged in to listen to a webinar on the state of transition in the banking sector 2024. 400 people have registered for this, making it one of the more popular webinars that TPI Centre and TPI have been running over the last year. We try to do these every 6 to 8 weeks to give an insight into the research and the outcomes of the research that TPI Centre is undertaking. We've also covered in the past ASCOR, the Assessing Sovereign Climate Opportunity Risk project, oil and gas sector, food producers, and the AI and the role of AI could play in climate conscious investors. As I said, I'm David Russell, chair of the TPI. I've been doing this role for just over a year now, prior to which I used to work for an asset owner, a pension fund, who's been a long-standing supporter of the TPI. And the TPI was launched originally in 2016, with a formal launch in 2017 with our academic partner, the London School of Economics, and now the TPI Centre at the London School of Economics, and a data partner, which was FTSE Russell, who provides some of the data for the research that the TPI Centre undertakes. We have 150 supporters, official supporters globally, and many of whom will be on this webinar, representing approximately $80 trillion in assets, but there's some double counting in there, as there is in many climate-related or investor-related amalgamations of numbers. But there are many more organizations out there using the data that the TPI provides. And what data do we provide? Well, we provide data on companies, how companies are transitioning to Paris alignment or net zero by 2050, sovereign debt and countries through the ASCOR project. We provide the data for the CA100, the Climate Action 100 project, which is a global collaborative initiative, 650 investors who engage with companies to encourage transition. And we do banking, and a little bit more on that in a moment. The assessments are based on public data only, and also the processes and methodologies used are very transparent and available on the TPI's website. And most importantly, the outputs of the TPI's work are open access and freely available on the TPI website, so anyone can use them. So today's webinar is very much focused on the banking sector, and you might think, why the banking sector? It's relatively low impact in and of itself, but it's actually really important in encouraging and making sure the transition happens. Why is that? Well, banks provide money to companies to do stuff, and that stuff could be transitioning or not transitioning. So if you want the transition to happen, banks have to be funding the transition and providing the resources that the companies need to make that transition happen. They're also exposed in of themselves to or their loan books are potentially exposed to physical risk of climate change, so that could affect the creditworthiness of some of the underlying assets. And of course, banks themselves are exposed, and the assets that the companies they provide funding to are exposed to regulatory risks as governments around the world regulate and put in place policies to address the transition. So it's really important for investors around the world to understand how banks are responding to the transition, what steps they're putting in place to make sure that they are transitioning, that the loans that they make to companies are transitioning. And so that's what the basis of the research that the TPI Centre has undertaken, and you're going to hear about over the next hour or so. I'm going to hand over to Valentin Yan, who's the deputy director of TPI Centre, and he's going to go through the agenda for the day, the housekeeping, and provide a presentation on the outcomes of the recent research that's just been published by the TPI Centre. So enjoy the rest of the session, and thank you.
Perfect. Thank you very much, David. So as David said, I'm Valentin. I'm the Deputy Director of Research and Operations at the TPI Centre, and I'll be presenting the results of our recently published banking report today. Looking at the agenda, we will first dive into the results. I will also provide some background on the methodology note. This presentation will be followed by a panel discussion with Masamichi Kono, who is a senior advisor at MUFG Bank and member of Global Advisory Board Mitsubishi UFJ Financial Group, as well as a trustee at the IFRS Foundation, and Maria Tenido, who is who works at the Financial Institutions and TMT Programs Director and at the Emerging Markets Investor Alliance. The panel will be moderated by Carl Nutzer, who is the Professor in Practice and Executive Director at the TPI Center at the London School of Economics. And at the end, there will be a Q&A and next steps. So on the Q&A, please post your questions in the Q&A and don't forget to upvote the questions that you find interesting. Please don't use the chat function. A recording also of this webinar will be made available unless we encounter any unforeseen technological difficulties. And the slides and the report should be available in the chat as well. On the left here, you can also see the cover of the recently published banking report, as well as a QR code where you can access the slides. So following on what David just said about the TPI, so we're the TPI Center, which means we're the research partner of the TPI, which is a global asset owner-led initiative supported by asset managers and service providers. As David already mentioned, one of our key objectives is to provide independent, rigorous research and data into the progress made by corporate and sovereign entities in the transition to a low-carbon economy. Another pillar being at the university of our work is that it's meant to be replicable, which means all our methodologies are available on our website, as well as the assessments being based on only publicly available disclosure. All of the information that you will see today is available open access on our website. So for every single bank, you can see its individual assessment. I'm not going to go into detail too much about the suite of entities that we cover, but at the bottom here, management, quality, carbon performance, and the CA100 disclosure framework represents our work in the real economy sector, largely focused on high-emitting sectors such as power and oil and gas. And on the right, you can see our work in the sovereign space represented by the ASCOR project, which stands for Assessing Sovereign Climate Opportunities and Risks. But today, we'll be focusing on our work in the banking sector, which you can see here. Just a few words of background on the banking sector. We started out on the banking, working on banks, really trying to work closely with the investor community to understand how a useful framework can be developed. So, for example, one of the core documents that form the basis of the ultimate framework that we came up with were the investor expectations published by IIGCC, and also the framework as a whole was developed in consultation with IIGCC and Ceres, who are two large investor networks. All right, so who have we assessed this year? In total, we have assessed 38 banks. You see 26 of them right now, because these are the 26 major international banks that we assess and that we have also assessed last year and formed the core of our work. We have 5 banks in Canada, 6 in the US, 8 in Europe, 4 in China, and 3 in Japan. The selection of the sample followed a threefold logic. First of all, we wanted to capture large banks by market cap as a proxy for investor interest. We wanted to have a good regional dispersion, and we also wanted to capture a wide range of different business models. This year, we have added 12 US banks because we had a focus on the US this year. And those 12 banks consist of 10 US super regional banks that you see at the bottom here, and 2 US custodian banks. So this is the sample of our assessment this year. For the most part, I will focus on the 26 major international banks, but this is to give you the full overview. And again, the in-depth assessment of each of those banks is available on our website. Moving on from who do we assess to how do we assess them. We assess banks on 2 elements, and we have one methodology for each of those elements. and they answered two different questions. So starting on the left with the Net Zero Banking Assessment Framework, or NZBAF, this is the framework I just mentioned was developed in close cooperation with the investors to ensure it's useful for day-to-day questions. This framework assesses banks' managerial practices, commitments, and policies. It consists of 72 sub-indicators, which are divided into 10 areas. So just to give you an idea, I will go into a little bit more detail in a moment how this works, but essentially, for example, if you're wondering whether a bank has set a net zero commitment, that would be one sub-indicator. And then usually we would be looking into some of the characteristics of that net zero commitment. So for example, what business units does it cover, etc. On the right, we have the carbon performance methodology. And this really aims to answer the question whether the targets that a bank has set are sufficient to align with international climate goals. So this is a quantitative assessment that measures the alignment of bank sectoral decarbonization pathways that we estimate. Again, I will go into a little bit more detail here later in the presentation. But because banks are really complex and are active in lots of different economic sectors, as well as across various business activities, we also capture the coverage of those targets as well, in relation to the sectors covered as well as the business activities. Again, a lot of that is going to become clear, but this is to give you an overview. Let me present the key findings from this year. So starting with the Net Zero Banking Assessment Framework. So this is the binary yes-no indicator framework that I was just mentioning. The key message is that banks remain largely not aligned with the goals of the Paris Agreement at present. What that means is that banks are still in the early stages of their net zero planning. However, if you look below that general finding, you see quite a lot of regional dispersion. So across all of the banks, so that's the 38 banks, we find that banks score on average on 15% of the 72 sub-indicators. But disaggregating this by region shows quite a bit of dispersion, with Chinese, US super-regional, and US custodian banks all scoring at or below 5%. So still very early in their transition planning. This is followed by the US global and Canadian banks that are both below 20%. And then we have the Japanese and European banks ahead with 27 and 29% respectively. One element on this, while we're at this high level perspective, to point out is there are two main reasons that explain the overall low level of scoring. And this is true across all of the areas that we assess, which is that, first of all, a lot of banks still don't have certain targets or financing policies, etc. But even those that do, most of the time, the existing commitments, targets, and policies often have a relatively narrow scope, focusing on a limited number of business activities and economic sectors. So this is a theme that we will come back to in the next slide as well. And lastly, because we have the special focus on the US this year, the performance of the 10 US super regional banks was significantly weaker than that of their international counterparts. And none of the US super regionals scored more than 63 of the 72 sub-indicators on of the Net Zero Banking Assessment Framework. And the overall, and that is problematic, especially because these banks have recently really increased their exposure to the oil and gas sector. All right, so now we've looked at the high-level takeaways. We've looked a little bit at the regional dispersion. So now let's go into the actual areas that we assess. So on the left here, you find the 10 areas into which our framework is divided. To give a brief kind of intuition for the framework, the first 3 areas, net zero commitment, sectoral targets, exposure, and emissions disclosure, are really aimed at understanding does the bank have this foundational net zero commitment? Has it operationalized this commitment through setting sectoral targets that can be measured also against low carbon scenarios? And what is the baseline for this bank? So the current emissions disclosure, as well as credit and revenue exposure to high emitting sectors. You will see that Area 4 historic emissions performance is currently vacant, and the reason for that is that we can track emissions trends using our framework across the banks, but no bank currently provides a sufficiently long time series on a consistent reporting basis for us to be able to do that. So this is the foundational section of the framework, which is followed by the question, how are you reaching your target? And this is really addressed in Area 5 and 6, decarbonization strategy and climate solutions. Decarbonization strategy is a set of sub-indicators that largely focus on financing policies with regards to fossil fuels, with regards to transition finance, and also with regards to deforestation. And that there's more in there, but high level, that's what it's focused on. Whereas climate solutions is focused on assessing whether banks have set targets to scale up finance to climate solutions. The last 4 areas, 7 to 10, are what I like to call the enabling environment. So what is essentially the support structure that the bank is putting in place to deliver on its targets? And that ranges from external factors such as climate lobbying policies to internal factors such as linking executive remuneration to achieving the bank's greenhouse gas reduction targets, for example. So looking, on this slide, I want to highlight where banks are doing relatively well, although we should note that on none of the indicators, on average, 26 banks fulfill more than half of the indicators. So again, overall performance is still quite low and in early stages, but where have they performed relatively well and where have they performed relatively poorly? Or, where are they still in the very early stages? So starting with the positives, maybe, we have a relatively good performance on Area 3, exposure and emissions disclosure. And here we find that reporting of financed and/or facilitated emissions is becoming more commonplace. It does remain fragmented across business segments and sectors. And also, while some banks disclose their credit exposure to high emission sectors, no bank currently discloses its revenue exposure. And that makes it difficult to understand the exposure of the bank as a whole, rather than just its credit portfolio. The other area where banks are doing relatively better is Area 8, here highlighted in green as well, on climate governance. And on climate governance, we see that most banks now acknowledge climate risk as a material risk and have given it board-level oversight. However, less than half of banks explain how climate risks impact their business and state their actions to address these risks. Furthermore, no bank assesses the climate competency of its board, and only a minority link executive pay to climate-related performance. So these are the positives. Let's look at the areas where banks are performing relatively poor. And here we have decarbonization strategy, which only on average 7% of the indicators are met by banks. And here we find that most banks have limited or no commitment to phase out or reduce their financing of fossil fuels, despite several banks recently updating their policies in this area. The limited scope of the commitments enables the continued funding of misaligned fossil fuel activities. Similarly, banks' policies on deforestation and land conversion often fall short of their commitments by covering only a few regions and not all high-risk forest commodities. So coming back to the theme of, yes, there are policies, but they are often not comprehensive. Area 7, climate policy engagement, we find that no bank has a policy in place to align its lobbying with the 1.5 degrees goal. And on Area 9, just transition, we find that a few banks have started to incorporate just transition principles into their decarbonization strategy, but no bank explicitly commits to decarbonize in line with just transition principles. If we disaggregate the results by region, we do find 4 areas where we find some interesting divergence. So the first one is that on Area 3, this is exposure and emissions disclosure, Japanese banks outperform both US and European banks on the progress they're making in comprehensively disclosing financed emissions, as well as financial exposure to high emitting sectors. On Area 5, so this is decarbonization strategy, we find that both Japanese and European banks are further ahead than the US counterparts in terms of setting financing policies with regards to fossil fuels, for example, but also transition finance, as well as deforestation. On Area 8, climate governance, we find that European banks are performing relatively better, and this is mostly because most Europeans now directly link C-suite remuneration with achieving their emissions targets. And lastly, on indicator 9, just transition, we find that no bank outside of Europe, or I should say, no Japanese or US global bank has really incorporated just transition yet into its decarbonization strategy, but we do find that European banks are starting to do so. Here is a slide that I just wanted to show that gives you an overview of the results by bank, sorted by brackets of percentage of yes scores on the 72 sub-indicators. We have Asian banks in light yellow, European banks in purple, and North American banks in dark blue. And you can see this trend of Japanese and European banks outperforming the North American counterparts. Moving on to carbon performance, so this is the question of do the targets that banks have set actually aligned with low carbon benchmarks? And here we find that banks remain largely not aligned with the goals of the Paris Agreement. Only 19% of sectoral pathways are aligned with 1.5 or below 2 degrees in the medium term, so that's 2035. And only 3% are aligned with the 1.5 degrees benchmark. Again, if you disaggregate the overall finding in terms of the sectors covered, so we're now focusing just on the targets by region, we find that on average, banks set sectoral decarbonization targets for 3.2 sectors. So that means, for example, that most banks will have set a sectoral target for the power sector, for the oil and gas sector, or the automotive sector. But again, in Japan and Europe, we find that banks are further ahead and have set targets for more sectors on average. When starting to set targets, banks prioritize setting decarbonization targets for certain sectors. So as I mentioned, electricity, utilities, oil and gas, and automotive sectors are the most common sectors for target setting. And that creates an obvious gap in coverage for other high emission sectors such as airlines, cement, food, diversified mining, and steel. We do recognize that, NZBA guidance, for example, recommends, a sequential target setting. But yeah, we do still find a significant way for a lot of banks to go there in terms of sectoral coverage. Additionally, we find that coverage of banks' decarbonization targets remains limited. So on average, only 22% of banks' total revenues are from activities covered by decarbonization targets. And when it comes to the temporal perspective, we find that banks mainly set targets in the medium term, and the lack of short and long-term targets makes mapping a clear pathway to net zero by 2050 difficult. So how do we go from targets to alignment? Let me give you a bit of an intuition here. So on this graph, you can see the bank's decarbonization pathway for the power sector measured in tons of CO2 per megawatt hour. And the way we estimate the bank's decarbonization pathway is that we rely on the bank's disclosure of its base year emissions intensity. So in this case, in 2024, let's say around 0.28 tons of CO2 per megawatt hour. And then we apply its decarbonization targets, let's say, 30% reduction by 2030. But this gives us a decarbonization pathway in intensity terms, and we can then compare that against the, for example, in this case, the IEA's reduction scenarios, again, on a carbon intensity basis. So, when we talk about alignment, we mean that, this bank would be aligned in the short, medium, and long term because its pathway is below that of the 1.5 degrees pathway over that period. How do you aggregate? Banks basically have to set targets for a lot of different sectors, and also they have often a lot of different business activities. So how do you aggregate all of these different targets and pathways? This is what we're aiming to do with this climate alignment matrix. So for every sector and business combination, business activity combination, you would then get a judgment based on the previous assessment, whether or not the pathway is aligned with, let's say, 1.5, below 2 degrees, etc. And you also have that for the short, medium, and long term. What are the findings based on this? So on the left here, you can see a summary of banks' alignment in the medium term, and there's a lot of detail, as I mentioned, behind every one of those alignment numbers. There's a full assessment behind it, and you can look at that on the website. But here we really just wanted to show you sort of, what the kind of information you can get from here. So you can see that, for example, ING Bank has set quite a few targets, and the targets that we can assess, they tend to be aligned with below 2 degrees or 1.5. On the other hand, for example, Barclays, you can see, has set the same number of targets, but the targets that it has set tend to not align with the low carbon benchmarks. The detail is in the devil here. So, for example, if you go on the website, you can then also understand which exact sectors are covered and in which sectors they're aligned. The key takeaways from carbon performance is that alignment with low carbon benchmarks is low. For electricity utilities, switching from global to regional pathways decreases the alignment even further. All banks' targets cover corporate banking, and 7 banks also include capital market activities in their sectoral decarbonization targets. Banks primarily set targets in the medium term, and banks mostly set targets using physical intensity metrics. So 75% of the targets are set using sector-specific intensity metrics, which is good news for our approach because that relies on these sector-specific intensity metrics. So with that, to you, Carmen.
Great. Thank you so much, Valentin, for the very detailed and insightful presentation. I can see that our audience is already very active. They've started asking lots of questions. So I'd encourage Valentin, you to take a look at them whilst I moderate the panel. My name is Carmen Nuzzo. I'm the Executive Director of the Transition Pathway Initiative Center at the LSE. And I'm delighted to be the moderator of today's panel that features 2 very distinguished speakers, starting from Masamichi Kono, who is a Senior Advisor at Mitsubishi UFJ Financial Group, or MFUG for short. Kono-san also serves as a trustee of the International Financial Reporting Standard Foundation from July 2021. So he's here with us wearing 2 hats, one based on his long-standing banking experience, but also his regulatory hat. Kono-san has had a very long and distinguished career in financial supervision and in the regulation of financial services, both in Japan and internationally, since he joined the public service in 1978. I would only mention a few of his illustrious posts, including being Deputy Secretary General of the OECD from August 2017 to October 2021, and prior to joining the OECD, Kono-san was also the Vice Minister for International Affairs Financial Services Agency in Japan and the President of the Asian Financial Partnership Center at the JFSA. And last but not least, Kono-san is also an advisory board member of the GFANZ APAC. GFANZ is the Global Financial Alliance for Net Zero, and also a senior advisor for the GFANZ Japan chapter. And we've also been joined today by Maria Tinedo, who is a financial institution and telco, media and tech, or TMT for short, director at the Emerging Market Investors Alliance, EMEA. Maria is a seasoned investment professional with over 20 years of experience in financial analysis and portfolio management, with a particular focus on emerging markets. And more recently, she's been focusing more on financials and energy as well. So thank you so much, Maria and Kono-san, for being with us today. Delighted to have you. Perhaps let me start by asking both of you, starting from Kono-san, for a quick reaction to the report. What struck you, and in particular, what do you think, based on the results of the reports, might be some quick and easy wins for banks to accelerate the progress in the net zero transition? What we presented in the report is really a static picture, if you will, of the findings based on what banks disclose, because we want to encourage accountability and transparency. So all our analysis is based on what banks have published. But obviously we haven't gone as far as explaining why the results have come out this way. So very eager to hear your thoughts on this. Over to you, Kono-san. Thank you.
Thank you, Carmen, for the kind introduction, and thank you so much for having me. Can you hear me? Oh, yes, thank you. Of course, I would like to first commend the authors of this report for their really hard work and effort to compare the large volume of information and put them in a comparable format. So this is certainly a great step forward. I also understand this to be a kind of a living document, because the situation is evolving quite rapidly. Of course, from one year to next, there will be further changes and hopefully lots of improvement. And we have been making progress for sure. Actually, so in my personal capacity, I would like to make a few comments, general comments, without going too much into the details, so that in future reports you may wish to further work on some aspects beyond what you have here. My disclaimer is that I'm speaking in my personal capacity, so I'm not representing officially any organization that you mentioned. Now, when you look at those results, I mean, a very simplistic way of looking at it is that, well, bank managers are not yet, let's say, aware of the need, or they're not willing to do it, maybe even becoming dinosaurs of the fossil age, etc. But actually, having observed not just from the OECD, but also from MUFG now, that's very far from the truth, that bank managers are now aware of the need to move forward, but there are actually quite a few practical impediments and challenges for banks in making those commitments and then publicly disclosing them. And well, these may be obvious to investors also, but lack of credible data, shortage of capacity and expertise for the banks and their clients. And in some cases, there are no real incentives for the bank's clients to provide the relevant information. So the banks certainly are now engaging with the real economy enterprises, but unfortunately, not all of the clients are forthcoming. And in the case of MUFG, actually, in April this year, it issued its first transition plan with sectoral interim targets. And in the course of developing this, and in this report as well, there is a certain process or procedure now for banks to engage with their clients, escalate the dialogue with the clients based on the client's willingness to develop transition plans, and also to, of course, implement them. And also there is a methodology for monitoring progress of the clients in meeting their own transition targets. So in that respect, again, the bank itself recognizes that there is much more room for progress, but again, lack of data, lack of capacity, lack of awareness on the part of the clients certainly are clearly impediments. And then, of course, in a way, as you mentioned, Carmen, it will be really good to look at why those banks are not disclosing, or first of all, not committing, and then not disclosing their sectoral targets in particular. And of course, in some cases, there may be room for simply raising the awareness, and certainly in emerging market countries, this may be the case. But at the same time, there has to be the government, the stakeholder community enabling, for example, the availability of data, the availability of the resources needed, education, and even just very good test cases or best practices, which will certainly encourage banks to come forward more, particularly in those areas where there are difficulties, those practical difficulties. And then, one suggestion is really to look at the why, but particularly the why in terms of where exactly the impediments are. And then second, I can also mention that the report certainly refers to the issue of differences of business models and materiality. But again, maybe you can deepen this analysis, because I mean, simply there is no uniform, universally agreed definition of materiality, and many are of course talking about financial materiality outside of Europe, whereas of course in Europe you may mean more about impact materiality, and so there's still a lot of confusion around the definitions, the terms being used, and so of course I will have to look more closely into your actual standards that you are using, but it will really help if this or maybe something similar to this is agreed at the international level, brought to the G20, etc. And of course, the IFRS Foundation is doing its part as well in developing S1 and S2 and then beyond. But we can do much more on that, and this report can also perhaps refer to the need for such convergence of practices, and also look at different business models in that sense more closely. So I will finish by saying that you might think that the banks have a lot of leverage in actually having the real economy enterprises to come forward with their commitments and the data, and then of course this will be transposed into the bank's financed emissions and also its own transition plan. But unfortunately, the leverage of banks is sometimes very much limited, either because of competition or because of non-existent regulation, or in many cases, actually, the government will have different priorities as opposed to decarbonization. And I'm, of course, mindful that in the Southeast Asian countries, for example, there are so many coal-fired power plants, but if you really want to phase down those coal-fired power plants, the banks have limited leverage, and we have to really start with a national energy plan, which is actually happening in some countries through the, for example, the Just Energy Transition Partnership, the JETPs for Indonesia and Vietnam, etc. But there still needs to be a lot more work done in that area. So maybe I should stop there.
That's great, Kono-san, and really this is the beginning of more work that we need to do together ahead. And the purpose of this webinar is to really encourage the beginning of this dialogue that we need to have with multiple stakeholders. You mentioned the government's role and the regulator's role in this space, but also the need to raise awareness and educate perhaps the various stakeholders to help in a way also banks to bring on board their clients and their investors in understanding what are the impediments that prevent them from making faster progress. And you mentioned something which is really important that also applies to the analysis that we conduct on our corporate assessments beyond the banks that we've just gone through, which is the need to provide more regional contextualization in the assessment, because that's quite important. Perhaps, Maria, this is a very nice segue because of your area of expertise. So I would like to also hear your thoughts about the report, and if you could add a bit of color based on your expertise on emerging markets about what could be the constraints that could impede faster progress from the financial institution sides going forward. Over to you. Thank you, Maria.
Sure. Thank you. Thank you for inviting me for this panel. It's a pleasure to be here. I also would like to commend you on the report and the framework. I think they are very comprehensive and insightful, and I hope you consider including other emerging markets into the assessment. I think it will be very useful for investors to keep engaging FIs in emerging markets. I would like to also say that the views I share here are my personal views, and they don't necessarily represent the members of the Alliance. About the report, I was surprised about the results, because in emerging markets, we tend to think that emerging market financial institutions, and in general, we lag disclosures of relative to developed markets. But I find the results, obviously you have the 4 financial institutions from China not scoring well on the assessment, but I don't think that is necessarily a reflection of all emerging markets. What I find is like similar to your results, some emerging market financial institutions are ahead of others. Some I would say in line with your top, the ones in the top side of the assessment. Few report facilitated emissions, very few sector targets, but I would like to focus on the positives that I have seen from the engagements in the last 2 years. What we have seen is that more financial institutions are joining the Partnership for Carbon Accounting Financials, the PCAF, to start measuring the emissions. Many are signatories, some using their methodology, but in general, dealing with data problems, data quality that Kono-san mentioned before, data availability, data quality, but also trying to adapt frameworks that were created for developed markets and that are used for emerging markets. And they don't always work, right? Because the issues in emerging markets, as Kono-san explained before, are very different. So, for example, we have seen PCAF has a chapter for Brazil now. In July, I think it was launched, and 2 of the private largest banks in Brazil, Bradesco and Itaú, are co-heading it, but also they have 13 signatories. So they're working together to deal with data. I've also seen financial institutions working together with other associations to solve problems, like disclosures of deforestation in Brazil. Financial institutions, the industry working with the association to work on common disclosures that will hopefully deal with the problem. Another positive trend that I have seen is that there are more financial institutions setting targets, sector targets. For example, we engaged one of them about a year ago. At the beginning, they only had 2 sector targets. There weren't even materials for their portfolios. Within a year, they added 3 more hard to abate sector targets, and they're planning to disclose another 3 towards year end. And I think more important, or equally important, is the fact that they're very aware of the just transition issues. Just transition is very important for emerging markets. So in setting the targets, they are considering just transition principles, but also taking care of nature and biodiversity. which is another very important topic for emerging markets. So of course, it's a very low, they're starting from a very low base, but they're moving forward. And I think we have to focus on the positive as well, because as Kono-san explained, there are many issues for financial institutions to show better results at a speedier pace. And the other issues is, transition finance is a very difficult topic for emerging markets. And we're seeing more taxonomies, definitely in Asia, to help with the transition. And we're also seeing regulators incorporating just transition principles and metrics into regulation and disclosure. And I think that's all, slowly moving, but moving in a positive direction, I believe.
That's great. Then thank you, Maria, very much for bringing to the fore concrete examples of where engagement and collaborative initiatives have helped to really make a better understanding of the baseline and encourage better disclosure, as well as encouraging the setting of sector targets. I can see that there are lots of questions, so I would like to ask more to you, but perhaps we can start addressing the ones that have come to the fore from the audience. And I would ask all of you to be quite succinct in your questions so we can get them through as many as possible. So the first questions are actually for Valentin, because they're more technical and based on the report. So Nick Harrison from the Environmental Defense Fund is asking, what's your view of financed emission as a metric for measuring progress on decarbonization? Valentin, do you want to address this?
Yeah, thank you very much. So I think there are really two aspects how we think about it. And on one hand, the calculation method using EVIC is not ideal from our perspective. But PCAF has been really instrumental in, so that's the methodology behind the financed emissions disclosure, in standardizing these disclosures, and ultimately that really helps us to conduct our assessments to determine the alignment of decarbonization targets. And so I think being able to understand, to compare the pathways of banks with each other and compare those pathways with low carbon benchmarks, for example, from the IEA, but you could imagine others ones as well, is really important, because ultimately that gives you the link back to the carbon budget. So, for example, I'm aware that there's a lot of work, for example, also happening focusing on moving a little bit away from decarbonization metrics, but I think having that direct link, the comparability, and the ability to compare these pathways against the carbon budget in a really concrete way is very valuable. So I think, to summarize, maybe the work they've done to enable comparability is really crucial, but we think there's still some methodological improvements that can to reduce the impact of EVIC. So that's the enterprise value, including cash. And the fact here is that changes in the EVIC really impact the financed emissions calculations. So you get fluctuations in those numbers that are not necessarily connected to changes in the underlying assets, i.e. the emissions profile of the bank's portfolio, but instead that are also linked to changes in the EVIC. And that is something that I think would be very helpful if that factor would be reduced over time through methodological innovations. And there are some ideas out there.
Great. Thank you, Valentin. There is a question specifically asked to Kono-san. It's coming from Giorgio Alba, who's a PhD student, and he's actually posed many. I'm just going to take one. He's asking, how should the banking sector anticipate and address the endogeneity between policy, regulatory action, and financial stability in the context of climate risk? Would you like to address that, Kono-san?
Well,
it's a complex question.
Yes, thank you. And well, but let's say from the standpoint of banks, actually, of course, if banks can actually improve their risk management, and at the same time, of course, make for a viable business that is seizing as much as possible the business opportunities arising in this transition. Then, of course, you will have resilient financial institutions. And by way of that, have financial stability, and of course, the regulators will make sure that they monitor the improvements in the sector. The issue is, of course, if too narrow a view of the risk, in the sense that you take every increase in the Scope 3 financed emissions as a risk, then that can be a problem, because, of course, not just because of the methodological issues and the quality of data, etc., but also because I would really reinforce this point that transition needs money, and for real economy firms to transition, upfront, they will have to make investments. They will have to find ways of somehow compensate for their lost cash flow, for example, in closing down prematurely a coal-fired power plant, for example. So you have to find ways of managing the risks so that you still get a temporary increase in financed emissions, but over time, based on a credible transition plan, this will lead to you to a truly net zero pathway. Whereas, of course, if you continue business as usual, it will simply not be possible. So this requires, of course, a certain collaboration, not just between financial regulators, but also with non-financial regulators, that is the ministries and the organizations responsible for the real economy, because, I mean, this is a whole government effort that we need. I hope that's acceptable as an answer.
Yeah, no, that's and actually, in doing the work on ASCOR, assessing sovereign climate-related opportunities and risks, we've encountered the same difficulties, that even within the same government, there are different lines of ministries that need to be involved and need to be taken on board to really understand the direction of travel, and also push forward national policy plans in a more coherent fashion. Perhaps I can actually address one of the questions from the audience was related to the fact that part of the regional differences in performance and scores may be explained in the policy context in their jurisdiction. This question came from Alex Lehman, or Lemon, forgive me if I don't pronounce the last name correctly. And the question is, can these differences be captured perhaps by the ASCOR sovereign assessments? And this is definitely something we're looking into, even in the recent State of Transition report for the corporate sector that we published last month. We started bringing this overlay through the ASCOR tool that we've just launched last year to provide this degree of nuancing around the sector assessments that we make. So it's definitely some work that we will continue to pursue further. I can see there are quite many questions related to some emerging markets, in particular to India. So perhaps some of these questions could be addressed to Maria based on her experience. In particular, there is a question related to India. I don't know if you are able to address this, because how can we get funds for decarbonization projects in India on behalf of anticipated carbon credit back financing, but more broadly in emerging markets, how can we channel funds to support the transition through the banking sector, which is definitely the predominant way for companies to get credit, given that in some of these emerging markets, the capital markets are not well developed. Would you like to address that, Maria?
Yeah, there are several impediments for funding of the transition in emerging markets in general. Kono-san mentioned before the difficulties of the transition in Asia. You know, as you know, emerging markets are very different, and you know, Brazil and Colombia, they have two-thirds of the generation of electricity based on renewable energy. South Africa, less than 10%, India less than 20%. The average age of power plants in Asia is 14 years, less than 15 years. In North America is 40. So the whole transition is very difficult, not only in India, but in general in emerging markets. Taxonomies are being developed really in particular in Asia. Now Brazil is developing one, but I find one of the problems with the taxonomies that are available today is the interoperability. It is believed that emerging markets need more than 2 trillion a year to fund the transition, that's not even including adaptation, and believe that more than 60% of that has to come from international funding. So that interoperability is very important. Having said that, I think that governments and policymakers are aware of it and that they're working on it. I think it's a stage. I think that interoperability will come. I think it is important to have local buy-in too, because the taxonomies have to also work on the problems of each specific country. India has been working on regulatory frameworks and disclosures that hopefully will be done by the end of the year. And I think that also, that clarity will help. Because one of the issues that financial institutions tell us as an impediment is the fact that they cannot de-risk projects because of policy and regulatory uncertainty. So sort of what Kono-san also touched upon before. So I think this is a moving target, and I am hopeful that with new taxonomies and that with the policy making and de-risking of projects, this will start moving forward.
Thank you, Maria. And actually, one other question, it was also, why is India not covered? And the simple answer is that we are limited in resources. This is a very labor-intensive exercise that we conducted, and our work is subject to funding. So obviously, we would be delighted to continue and expand the coverage to as many countries as possible, but we're limited for now in what we can do. Perhaps I go back to Valentin for a couple of more technical questions. Somebody's asking what is the difference between this framework that we've developed and the analysis that the SBTi conducts, and at the same time I can merge this with another question that is asking the differences with NZBA and the GFANZ. Back to you, Valentin. Thank you.
Thanks a lot. So on the first question, I think broadly, there are quite a lot of similarities. We both focus on net zero commitments, baseline and reduction targets. If you want to focus on the differences, I think the net zero banking assessment framework goes a bit further in the sense that it also really focuses on financing policies, in particular with regards to fossil fuels. And also, just by the way, the fossil fuel financing indicators are really based on IEA findings, such as needs for coal power or needs for expansion of new oil and gas. So it's not there's quite a bit of nuance, I think, that we were able to kind of build into those fossil fuel financing policy indicators. But just as a side note, and additionally, as I said, we also focus on on lobbying just transition. So maybe to summarize, I think the net zero banking assessment framework was built from a slightly different perspective, in the sense that the question was, now that you have a net zero target, how do you become a net zero bank? Which is more than just reducing your emissions to zero by 2050, and potentially being involved in very underlined activities in the meantime. Lastly, I think another really conceptual point to make is that the sorry.
No, so very quickly, Valentin.
Okay, sorry. Sorry, this is just is that the SBTi creates standards and verifies the implementation of their standards, whereas I think we have an assessment framework, so we track progress over time rather than giving verifying something once it's essentially complete. So there's more of a tracking element, I think, to our work. Sorry, I will keep it short for the next question.
No need to say sorry. Actually, the time has flown a lot quicker than it normally does. It seems to, and I really want to thank, first of all, the audience for being so engaged, which tells me that we should probably organize another webinar quite soon to follow up, because this has generated quite many questions and a lot of interest. So I'm very pleased with that. This is definitely early stages, as the report has highlighted, and there is more work ahead that we at the LSE will continue to do, and we will involve multiple stakeholders, including the investors for whom we work as a primary audience target, but also the banks, the investee entities themselves that we assess, and the regulators. So it's something that we will continue to pursue, and a dialogue that we want to nurture. So please join me in thanking Kono-san and Maria Tinedo for her participation today, Valentin for his excellent presentation, David Russell for being with us, as well as my colleague Alex Barrows, who's been working behind the scene to ensure that this webinar ran smoothly. The report is available on our website, www.transitionpathwayinitiative.org, but also there is a link in the chat function. The slides will be made available to those who've registered for the webinar. Please also read the State of Transition report on corporates that we published last month, and stay tuned for the forthcoming State of Transition report on sovereigns that will be published before the end of the year. Until the next webinar, thank you and goodbye. Have a good day or a good evening, depending on where you are.
Thank you so much.
Thank you.
you.
All the best.
Bye.